Welcome to CalPERS School Employer Advisory Committee. I will now turn it over to your presenters for today. I would like to turn it over to our first presenter, Susan Four. Susan, you now have the floor.
Good morning, everyone. Thank you for joining us today for the School Employer Advisory Committee webinar. My name is Susan Four. I'm with CalPERS Employer Response Team, and I'll be your moderator this morning. Today's presentation will take about 75 minutes with an additional 15 minutes or so for questions. Some of you have provided us questions in advance, and our goal is to address those along the way. If you have questions during the presentation, please type them into the Q&A feature, and we'll try to get to as many questions as we can. Next slide, please. We've gathered several CalPERS leaders and team members for this event. You'll be hearing from Renee Ostrander, who is the Chief of the Employer Account Management Division. Renee will be speaking about COVID-19 impacts to CalPERS reporting. Donna Beaumont is from the Customer Education and Outreach Division and will share new virtual classes from our Employer Education team. Veronica Silva-Gill, Brad Hansen, Michelle Norris, Brianna Lawati, and Christina Rollins are all in the Employer Account Management Division. Veronica will provide information about the State Social Security Administrator Program funding, and Brad will remind you how to track and report out-of-class appointments. Next slide, please. Michelle and Rihanna will provide answers to your frequently asked questions regarding late enrollment. Christina will update you on post-retirement employment. Kurt Schneider is in our actuary office. Kurt will talk about current markets and future contributions. Jennifer Rocco from the Employer Account Management Division will be available to assist with answering your questions at the end of our meeting. Next slide, please. And finally, members from the Employer Response Team will assist with question and answer portion of this webinar. The team consists of William Greenhalgh, me, Susan Four, and Stephanie Duncan. So with that, I'll turn it over to Renee Ostrander.
Thank you, Susan. All right, let's get started. What we're going to do is we're going to discuss a little bit about the different circular letters. Here at CalPERS, we've been very busy for the last couple of months trying to reorganize so that we can continue to help you to do the work that you need to do. Next slide, please. Okay, so what we're going to do is we're just going to go over, like I said, the 4 circular letters that we issued between mid-March and mid-April, and hopefully I'll be able to answer some of the questions that you have. I do have a few of them that came in before, so I'll try to weave those in as we discuss it. We're actually going to start at the bottom of the list and work our way up. So the first circular letter that we issued was 200-015-20, and that had to do with the governor's executive order that he issued in early March. And what this circular letter talks about is that the governor's executive order lifted the 960-hour limit and the 180-day restriction for those retired annuitants that are working to ensure adequate staffing because of COVID-19 issues. So, and they can be retirees that you're bringing on new to shore up staffing because you've had some losses, or individuals that you were using on some limited term basis that then you are transitioning to help cover to ensure that adequate staffing. We do have some examples in a later circular letter that we've released as well. So one of them had to do with maybe it doesn't have to always be related to specifically to doing some type of COVID work, but that ensuring adequate staffing could be a payroll tech. So if you have a payroll tech that is maybe unable to work because their children are at home and distance learning and they're having to help them, so they're having to take some of the emergency family medical leave time or the emergency sick leave time, then, and you're hiring a retired annuitant to fill in their place, that would be an example of someone that's ensuring adequate staffing. Or maybe you've had to hire additional janitorial staff to be on site. And so that would also be someone that would qualify under this idea of ensuring adequate staffing. Another item that we talk about in that circular letter is the lifting of the 60-day restriction if you're under normal retirement age. That was actually lifted with a prior governor's executive order. So, but what we want to make sure we highlight are there are certain things that were not lifted by this. So this doesn't remove all restrictions related to retired annuitants. First off, it does not stop the need or stop the requirement that you cannot have prearranged agreements if you're under normal retirement age. So if a retiree goes to retire under normal retirement age, they cannot have a prearranged agreement to return. Also, the pay requirements are still in place. So a retired annuitant should be reflected on a publicly available pay schedule, and they should not be receiving any extra benefits. So they should not be receiving longevity pay or some type of educational pay, something of that nature. Those are not allowed for retired annuitants. And then also, if they're filling in a specific role, you still have to have the interim resolution. So if an interim resolution would have been required for the type of role that they're filling, that is still required. Okay, so that about covers the circular letter 15-20. Let's go on to 16-20. That one covered all of the frequently asked questions that we had been receiving at that time. So the first piece was related again to retired annuitants and the notifications. We talk a little bit in there about how those notifications work, even though schools are not quote unquote state employer. All CalPERS covered employers are required to report to CalHR, and then CalHR will take care of reporting that to us. And so then we're able to identify those individuals as covered by the governor's executive order. And then we send notification letters to those retired annuitants to let them know they are recognized as a retiree that has the exemptions that apply to the governor's executive order in 2520. Another piece in the FAQ circular letter has to do with payments that are PERSable and not PERSable. And so we talk a little bit about unemployment. So there were some questions about whether or not unemployment insurance is reportable. And the answer is it is not. There were questions related to administrative time off. And so if an employer is granting administrative time off, is that reportable? And the answer is yes. You'll actually find that in Government Code Section 20630, I believe, and that will let you know that administrative time off is one item that is PERSable. The last set is related to reporting payroll, requesting extensions, and requesting waivers of fees. So if you're having some struggles getting your payroll in, maybe you don't have people available because, you know, like I said, maybe they're at home distance learning and they're not able to come in and submit the payroll. Maybe the people that are trying to do it aren't educated in payroll, so they're kind of having to work through it and we're having to help. We are happy to help, but if it's going to be delayed, you can request those extensions. That's available in the system. If you run into problems where the extension still is not sufficient, you can give us a call at our 888 CalPERS number, and we'd be happy to provide a second extension. If for some reason you go past those extensions, you still can request a waiver of fees. And you can do that through the 888 CalPERS number. They'll give you the directions. The circular letter also provides you directions on how to do it in the system. Okay, circular letter number 3 had just very quickly has to do with employer payments. All of you are already paying electronically, and so the importance is just to continue to pay electronically. It does help us here at CalPERS so that we don't have to have someone physically in the office handling checks. So if you do have any questions related to submissions of payments, you can always give us a call at 888-CalPERS, and we will help you out with that. The final one, which I think probably will generate the most questions, has to do with the federal leaves. So with those federal leaves, the Families First Coronavirus Response Act, there were two types of leaves that were provided. And that was the emergency paid sick leave and the emergency family medical leave. Both of those leaves are reportable to us, and so you'd want to report these individuals at the regular pay rate and then their earnings towards that amount. That we utilize both of those pays to calculate their service credits. If you have any questions, we're happy to help you work through that. Those leaves also are okay to be paid to a retired annuitant. I know as we talk about, there are no additional leaves that can be paid. Since this is federally mandated to be paid, we are okay with that. The other item is that the leaves are countable towards membership. So if you have individuals that work for you that you're counting towards the 1,000 hours, again, towards that regular pay rate and the reporting, the equivalent hours needs to be calculated. And if they do reach 1,000 hours in this fiscal year, then you need to follow their requirements in terms of reporting. That covers all of mine. I did receive one question to know that how they would know if they're approved. So if someone is approved for the governor's executive, through the governor's executive order to have that lifting of the 960-hour, the 180-day restriction, how would an employer know? And the answer is that they would know because they do receive a copy of the letter. There's also feedback from the initial report that's sent to CalHR. So there's a lot of communication that goes on this, a lot of awareness. And with that, that covers mine, and I'm going to turn it over to Donna Beaumont. Donna Beaumont, you have the floor.
Thank you, Renee. Good morning, everyone. It's nice to be here with you today. I'm Donna Beaumont, Manager of External Education Services, which provides employer education as well as administration of curriculum development for CalPERS member education delivered by our 8 regional offices. Next slide, please. I'd like to take a few minutes to talk to you about the CalPERS Employer Education Program instructor-led training normally provided in person at CalPERS 8 regional offices and on location with our employer business partners, about how changes were required due to California's coronavirus stay-at-home order and how we were able to be responsive to your education needs. Next slide. Due to the stay-at-home ordinances, we were unfortunately required to cancel all in-person training for the second half of March and offer those who had enrolled alternative education resources, such as online classes, myCalPERS student guides, and scheduling one-on-one myCalPERS employer training phone or web conference consultations. Because our employer education team had begun exploring other channels of education delivery as a part of an annual plan goal, we were able to quickly make adjustments to continue education services to our employer partners. Next slide. Welcome the WebEx Meetings platform. This platform allows the presenter to be visible and interact via video conferencing, showing the class curriculum or presentation through screen sharing, and provides a chat feature as well as verbal dialogue for questions and information sharing. The employer education teams were able to convert our in-person classes from April going forward to WebEx virtual classes. Next slide. A lot of preparation work went into making this happen. The education teams created a communication and outreach plan for enrollees and resources to help attendees have a successful class experience. One resource was a guide for the CalPERS host, but most importantly was the attendee guide for Cisco WebEx meetings to help the learner participate in virtual classes. Attendees were sent a welcome email to set expectations prior to the class, which included class details, the guide, and training materials for their successful participation. A fillable evaluation was also provided to help us gauge effectiveness of the virtual classes and make improvements based on attendee feedback. Next slide. The virtual classes were very successful with 39 enrollees for the first pilot of these virtual classes in April. Responses from those attending the trainings were very positive, such as all the materials were sent ahead of time in the email invite with all of the details, and I was completely prepared to follow along with ease. This proves the virtual classes can be nearly as interactive as the in-person classes and gives us more options in classroom delivery for employer education moving forward. Our next instructor-led WebEx classes will be May 19th and 20th, with retirement and health business rules classes on May 19th, and a variety of myCalPERS system classes the 19th and 20th. You can enroll from the Education tab in myCalPERS by choosing Instructor-led under the Classes tab. Next slide. In addition to virtual class offerings, the Employer Education Program provides multiple online classes to help you get the information you need at any time. During the month of April 2020, we saw a significant increase with 470 online classes taken and a satisfaction rating of 96%. This is a 229% increase over last year in April. Accessing online classes is as easy as 1, 2, 3. Select the Education tab in myCalPERS, choose Online under the Classes tab, and simply click the Start button to launch your desired online class. The list of 60 online classes are categorized by topics and is available for you to view on the CalPERS Employer Education webpage. Next slide. Thank you for allowing me to share the efforts the Employer Education Program has made to continue serving you during these unprecedented times. For any inquiries related to your training needs, please feel free to email our CalPERS Employer Communications mailbox at the address on the screen, and we'll respond to you promptly. Thank you very much for your time today. This concludes my presentation, and now I'd like to introduce Veronica Silva-Gill. Next slide.
Good morning. Thank you, Donna. This is Veronica Silva-Gill. I am the team leader over the State Social Security Administrator Program. And today I would like to tell you about the program funding. Next slide. So I would like to give you some information about our funding program. So I will review the fee amounts and then provide you with some resources. Next slide, please. So let me give you some background about the program funding as to the why we are having to issue invoices as a program. The State Social Security Administration regulations require that every state has an official to administer the provisions of the Section 218 agreement, and they don't send us money with that. CalPERS was the designated administrator beginning in 1955. So before 1980, we used to collect the taxes in addition to doing the Section 218 agreements and providing education outreach, even all the other activities that we have. And in 1980, when the duty of collecting the taxes was moved to the IRS, we stopped collecting the fees and we didn't have any more income coming in and no interest. So since about the 1980s until now, we have our program has been surviving from the leftover interest and the fees that we collected from back then. And as you can imagine, the fund has now diminished, and we are having to go back to the employers that have a Section 218 agreement to assess, an annual fee so that we can keep the program going, and of course, follow the Social Security Administration regulations. The state legislature does not allow CalPERS to use any of the retirement funds to cover for our expenses, so that's why we have to keep our separate fund and to collect the fees. Next slide, please. The maintenance fees are based on the number of employees who are employed at the agency, at the school districts. It will include both certificated and classified employees. I think the best way for you to figure out how many employees is, how many W-2s did you issue. The invoices will be generated annually, and the COE will get a copy of the school district's invoice as well. So each district will get their own invoice, and then the COE will get their separate invoices and a copy of the school districts that are beneath them. Next slide, please. So all the school districts are covered under Modification 315, and they will all receive an invoice. Like I mentioned, the school district will get their invoice, the COE will get a copy. If the COE has a Section 218 agreement, which some of the County Office of Education enter into their own agreement after they became independent from the schools, then they will also get their own invoice. There are some County Office of Education that only have a Medicare-only Section 218 agreement, and we are not assessing an invoice for those. So only the ones that have Section 218 agreements for Social Security will receive an invoice. Next slide, please. So the number of employees will be based on both the classified and certificated positions, and our office has obtained information from either the CalPERS records to determine the number of employees. We have also reviewed the California Department of Education and the State Controller's Office. So we have loaded that information into the system, and of course we'll work with each of the school districts to determine the appropriate count, as time goes by. Okay, next slide. So if you have any questions, please send us an email. Our email address is 3SS, SSS, as in Sam, A @calpers.ca.gov. We also have a direct line, which is 916-795-0810. We anticipate that the invoices will be generated in this month. So they start looking at your records, they'll be coming. And if you have any questions or there is any discrepancies, please feel free to reach out and we'll assist you. Next slide. Yeah, here's some additional resources. The circular letter that we issued last fall, and I'm sorry, it was actually last summer, is number 200-02219 that provides detailed information about the invoices and how to make payments. Also, if you need to designate someone in your school district or the COE to make payments, the student guide on the myCalPERS electronic transfer can provide you some details on how to provide that access to the designated employees. And I believe that's it. The next slide, I think that's it for my slides. Yes. So this concludes my presentation, and now I would like to introduce Brad Hansen.
Thank you, Veronica. Good morning, school friends and employers. How's everyone doing today? I'm assuming that your silence means everyone's doing okay. So let's get started. I'm just here to kind of remind everybody about out-of-class appointments and kind of clear up some of the questions that we've had about out-of-class appointments and temporary upgrade pay, and then also kind of answer your questions on when there would be a penalty assessed. Next slide, please. Okay, so just to recap, the Government Code 20480 passed on January 1st, 2018. And the purpose of that law was to track out-of-class hours for both classic and new members, the PEPRA members. Its purpose is to ensure that all out-of-class appointments are accurately maintained and tracked, and increase transparency when a member is assigned to an out-of-class appointment. Basically, this law was passed to ensure that if people were in these out-of-class appointments, that they were being compensated for them. And if they weren't going to be compensated for them, it should be limited to a specific amount of hours, 960 hours. Next slide, please. So the definition of a out-of-class appointment is someone who is temporarily appointed to an upgraded position. The vacant position is under a recruitment, The appointment must be for a limited duration and cannot exceed the 960 hours. So it has to meet all 4 of those criteria to be an out-of-class appointment. So for instance, if you had a vacant position, but it wasn't under recruitment, and you put someone in an upgraded position, it would not qualify as an out-of-class appointment. Okay, next slide, please. Okay, so we kind of covered what an out-of-class appointment is. And then one of the most common things that I hear from our employers and members is, does that mean that there's a limitation on how much temporary upgrade pay someone can earn during a fiscal year? And the answer is no, there is no limitation on it. In fact, if someone is getting paid temporary upgrade pay, they're not going to more than likely be subject to the out-of-class penalty. So first, let's cover what temporary upgrade pay is. So temporary upgrade pay is a special compensation. It's available only to classic members. It's covered in the government code regulations in the payroll under 571. In order for a member to receive temporary upgrade pay, they have to be performing 100% of the duties of the upgraded position. The position must be on a salary schedule. It has to be available to an entire group or class, and it's also contained in your labor policy or written agreement. So that's what temporary upgrade pay is. Now, it's not reportable for PEPRA, and the reason that I mention this is that with out-of-class appointments, in order for an employer to be penalized, that means that their contributions would not be reported for the person in the out-of-class position. So if someone's receiving temporary upgrade pay and they're eligible to have it reported, those contributions will be in the system, and thus there will be no penalty. For PEPRA members, however, it's not available. So if someone was receiving temporary upgrade pay and it wasn't reported to CalPERS because it can't be reported, that's where you may run into a penalty. And 99% of the penalties that come from out-of-class appointments will come from this situation, a PEPRA member receiving temporary upgrade pay but not having it reported to the system. Next slide, please. So the penalties for an out-of-class appointment would be 3 times the amount of all contributions paid on the compensation directly attributable to the out-of-class appointment. The penalty shall be for all hours worked in the out-of-class appointment in that fiscal year. And the amount would be the difference of contributions that would have otherwise been paid to the system. Now, you notice that underlined would have otherwise been paid to the system. So that means that if the contributions are there in the system and the person exceeded 960 hours, there would be no penalty. So for example, let's say that my boss, Renee, left and I was temporarily upgraded to her position and I worked in 1,000 hours in that position. True, I exceeded the 960 hours and assume I met all the other criteria. The fact that I received temporary upgrade pay and it's reported into the system, those contributions are there. We would still have you report the hours, we would do our assessment, but at the end of the day, there would be no penalty because the contributions would be with CalPERS. Next slide, please. Okay, so now we're going to play a little game. It would have been more fun in person because I could have called on some people to see what the answer is, but I'm just going to be the quizzer and the answerer on this particular game. Okay, so I'm going to give you 4 different examples, and we're going to determine if there should be a penalty or not on the out-of-class appointment. Okay, so for example 1, Brad is a classic member. While his manager is on a medical leave for 6 months, he receives temporary upgrade pay. The position is not vacant. There is no recruitment. Brad has worked 1,032 hours in the upgraded position. Will his employer be penalized? So think it over for a moment. Just gather your answers. Okay, let's move on. The answer is, next slide, please. No, there would be no penalty. 1, the position was not vacant. It didn't meet the criteria. There was no recruitment because my boss was on a temporary leave of absence. And even if it was vacant and there was recruitment, the contributions were reported because I was a classic member receiving temporary upgrade pay. All right, next slide, please. All right, example 2. Jennifer is a PEPRA member. Jennifer's manager retires. Her employer recruits for that vacant position. Jennifer is temporarily upgraded to manager for 6 months while the employer recruits. Jennifer works 1,032 hours in the upgraded position. She received temporary upgrade pay. Will her employer be penalized? That's a good question. Next slide, please. And this one, the answer is yes. And the main reason why it's yes is because Jennifer is a PEPRA member. Temporary upgrade pay cannot be reported for PEPRA members. Contributions were not reported for the out-of-class appointment. So this would be one of those rare examples where an employer could be penalized for the out-of-class appointment. We would look at those 1,032 hours. We would take the difference from what her pay was and to the job that she was upgraded to, and we would multiply that by 3 to assess the penalty to the employer. All right, next slide, please. All right, example number 3. Renee is a classic member. Renee's manager retires. Her employer recruits for the vacant position. Renee is temporarily upgraded to the manager position for 6 months while the employer recruits. Renee has worked 1,032 hours in the upgraded position. Will her employer be penalized? Next slide, please. The answer is no. Renee is classic. Again, temporary upgrade pay was reported. Contributions were reported to the system. Even though she exceeded those 960 hours, the contributions were reported on her appointment. And that's kind of the whole point behind this out-of-class reporting, that members in these out-of-class appointments should be compensated for working in those positions. All right, now let's go over the last example. Next slide, please. Example 4. Christine is a PEPRA member. Christine's manager retires. Her employer recruits for the vacant position. Christine is promoted on a temporary basis to perform the manager duties. Christine receives the pay rate of the manager. Christine works in this position for 1,000 hours. Should her employer be penalized? This one's kind of tricky. Next slide, please. There would actually be no penalty on this one. Christine is PEPRA, true, but she was upgraded to that position. So there was a personnel action form, let's say. So instead of giving her temporary upgrade pay, they actually moved her into that position temporarily, and they reported it as pay rate. It's a little bit different than temporary upgrade pay because there was a personnel action form that they actually moved her into that position temporarily. In cases like that, that is reportable to CalPERS for a PEPRA member, and there'd be no penalty. So those are the most common types of scenarios we see, and as you can see from this presentation, that oftentimes there will be no penalty for these out-of-class reporting. Even though that we don't get a lot of penalties, you're still required to report every year who your out-of-class appointments are, regardless if they reach the 960-hour limit or not, and regardless if you're paying temporary upgrade pay for them. Next slide, please. So the reason why we're presenting this right now is just kind of as a reminder that the tracking for the out-of-class appointments is going to be due very soon. We're going to be sending out an annual notice at the end of June just to remind everybody to go into myCalPERS and report the hours for your out-of-class people. Next slide, please. And for those who aren't aware, we did add functionality on the myCalPERS system. There's actually a circular letter with links to training courses on how you can perform the tracking online. I get to that slide next. But the myCalPERS functionality will allow you to submit records for employees who meet out-of-class hours worked, associate labor agreements and salary schedules to out-of-class records, certify there are out-of-class hours to report, view penalties that may be assessed in accordance with Government Code Section 20480, and view receivables and pay invoices for assessed penalties. So it has all of that functionality, and you just simply go into your myCalPERS page and report under that tab. Next slide, please. And then the circular letter that I just referred to is circular letter 200018-19. So if you go onto the CalPERS website, you can always pull that up. And again, there are links with instructional guides and training on how you can report online in case you're not familiar with it. So that's all I have for today. I'm now going to pass it over to Michelle Norris and Renee Lawati so they can talk to you about their subject. Thank you.
Thank you, Brad, and good morning, everyone. My name is Michelle Norris, Section Chief overseeing the Membership Review Team.
Good morning, my name is Rihanna, and I'm in the Membership Review Unit.
And next slide, please. All right, today we'll be going over some common questions specifically related to arrears determinations outlined in the notification of reported late appointment, and we will also be providing answers. Next slide, please.
So our first question today is, can the $500 administrative cost be waived? So the answer to that would be no. If employer paid arrears is determined, then Government Code Section 20283 applies and the $500 administrative cost cannot be waived. Next slide, please.
All right, question number 2. Can the employer paid arrears determination be changed once we've made that determination? And the answer is yes. If the determination is not correct, or if you feel that we don't have enough information based on the determination, additional information can be provided with 30-day appeal window to support the change. And we'll review it again and make a new determination if it justifies. Next slide, please.
And then what if you think the notification of reported late appointment was sent to your agency in error? So in this case, please send an email to the Membership Appeals mailbox with an explanation. We will review and respond. So this could be in the case that maybe the wrong enrollment eligibility date was entered. Maybe a few days later, oh, I need to go in and correct this. So at that point, just provide us that full explanation and we will review and respond accordingly. Next slide, please.
All right. If your agency does not agree with the arrears period in the determination, should you hold off on reporting payroll for the arrears time frame? And the answer to that is yes. Please wait to report the payroll until the issue with the determination has been resolved. Next slide, please.
And so our next question is the employer billed separately for the arrears contribution? So the member and employer contributions are billed in the current earned period receivable, just like any other payroll reporting. Now the administrative cost of $500 will be billed separately in the arrears panel, and that's within the billing and payment pages. Next slide, please.
What happens if payroll is not reported for a portion of the arrears period? The member could potentially end up not receiving the full service credit that they are entitled to. The missing payroll will appear within the retirement appointment reconciliation pages until reported or reconciled. Next slide, please.
And should our agency report missing payroll on past late enrollments when an arrears determination has not yet been made? So at this time, please report payroll only if instructed by CalPERS to do so. Next slide, please.
All right. We're in the process of developing and implementing additional enhancements in myCalPERS related to membership reviews. So please stay tuned for more information as we will provide more information at a later date. Thank you, everybody. This concludes our late enrollment portion of the presentation. At this point, I would like to turn it over to Christina Rollins.
Thank you, Michelle. I'm Christina Rollins, manager over the Membership and Post-Retirement Determinations team and the State Social Security Administrator team. Today, I'm going to be providing post-retirement employment updates and information. I will discuss upcoming and current myCalPERS enhancements and provide a COVID-19 emergency relief update, which Renee Ostrander also discussed in her presentation earlier. Next slide, please. As we preach in all of our working after retirement presentations, retired annuitant compliance is the responsibility of both the retiree and the employer. The system enhancements are a further way for us to assist employers and retirees in staying compliant with the working after retirement restrictions. Next slide, please. So all of these following enhancements that I'm going to be going over have been implemented and have been implemented since the end of April. So first, we have a welcome letter that will be sent to retirees once a retired annuitant appointment is keyed into myCalPERS. The letter will have information about the retired annuitant appointment and provide information about the working after retirement restrictions. Next, for employers, there will be a limit to the hours you can report in the system. Once 960 hours are reported for a retired annuitant, an error box will come on the screen notifying you that the retiree has already worked hours. In addition to the 960-hour box that will appear in myCalPERS, our warning letters will now be sent out at 600 and 700 hours to all retired annuitants that are getting close to approaching their 960-hour limit. And those letters will also have a CC to all employers the retired annuitant works for. And I think I've talked about this in past SEACs, but employers can also run a report to find out how many hours have been reported for a retiree for every employee they work for. This past year, we found that there were a lot of employers reporting special compensation for their retired annuitants. Items such as longevity pay and differential, for example. Letters went out to many of these retirees informing them that they were in violation of the working after retirement restrictions by receiving this pay. The special compensation enhancement will now display a warning box when an employer tries to input special compensation for the retiree. The warning box will inform you that retired annuitants cannot earn special compensation in retirement and as a retired annuitant. Last, retirees will now be able to log into their myCalPERS online account and view the number of hours that have been reported in the fiscal year for all CalPERS covered employers that they work for as a retired annuitant. Next slide, please. So Renee went over earlier the executive order for COVID-19 issued by the governor. Again, these appointments will suspend for retirees the 960-hour rule, the bona fide separation, and the 180-day requirement. It's important to note that all other working after retirement restrictions will apply. For retirees that you believe falls under this order, you will send in an exemption request to CalHR at the email address here on my screen. Once CalHR approves the appointment, it will be sent to CalPERS for our records, and we will send a letter that it is approved, and we will send that letter to the retiree and the CC to the employer. Next slide, please. I know Renee covered this, but as another reminder, we have a number of circular letters related to COVID for both employers and retirees in regards to retired annuitants, reporting, pay, FAQs, and requirements that a retiree or an employer will have to follow as a result of COVID-19. Next slide, please. And finally, as always, we provide a number of resources for you to contact us. We have our toll-free number, CalPERS Online, as well as the membership and working after retirement mailboxes. You can submit questions. Next slide, please. Now, I would like to introduce Kurt Snyder from our actuarial office.
Thank you, Christina. Yes, I am Kurt Snyder from the actuarial office, and what I'm going to go over is two separate things. One, I'm going to talk a little bit about the current financial markets and what that impact that's going to have on school employers, and also the contribution rates for next fiscal year. Next slide, please. So this time of year, we complete the valuation from the prior year. So last month, we took to the board the results of the actuarial valuation dated June 30, 2019. And that's what determined the employer contribution rates for the upcoming fiscal year 2020 and 21. But of course, all that's happened in the financial markets, that's all happened in 2020. So it isn't reflected in these rates, but you still need to know these rates because that's what the employers are going to be paying starting in a couple months. Reflected in this valuation is the fact that the state contributed an extra $904 million to the schools pool last July in order to relieve some of the contribution requirements from the employers. Next slide. So these are the essential results that people need to know is the what the employer contribution requirement is. The first column there is the current contributions from the prior valuation, the 19.721% that employers are currently paying. The middle column there, we're just trying to show you that because of the timing of the valuation, we had to give employers some notice, and we projected rates for them back in September. And what we told them was likely going to be their contribution requirements for the 2020-21 fiscal year was the 22.8%. And the right-hand column is what we've actually calculated and what's been adopted by the board, the contributions for next fiscal year, the 22.68%. Next slide. This slide just shows the funded ratio over time. You can see that it's kind of a little bit of a decline over the last few years. The current year, the funded ratio declined from 70.4% to 68.5%. There's three main reasons for that. One reason is that the investment return for that fiscal year was about 6.7%. And for this valuation, we had been assuming 7.25%. So there's a little bit of an investment loss that's going to have to be paid for by employers. There's also the fact that because we are so sensitive, or we know employers are so sensitive to contribution increases, we increase them very slowly when they need to be increased. And because of that, they're not really keeping up with what's required to fund. So the contributions are less than interest on the unfunded liability, so that interest accrues and causes the funded ratio to decline. And the third thing was we actually changed an assumption, the discount rate in this current valuation. We reduced the discount rate from 7.25% to 7%. And that, just like everything else, it's sort of self-correcting. At the point you reduce the discount rate, the funded ratio drops because your liabilities are higher. But going forward, your investment performance is better. You have better gains and smaller losses. So that funded ratio winds up in a better place in the long term. Next slide. All right. So I mentioned that the funded ratio fell a little bit and contributions had to increase because in the fiscal year prior to that valuation, the return was 6.7% rather than 7.25%. And now this current year that we're in, we're assuming 7, but it's probably going to be well below that. Because back in February and March, when this COVID-19 thing hit the United States and the financial markets, the market value of the fund fell. So the return, when I prepared this slide, the return for the fiscal year was about 0%, which is well below the 7%. Right now it's up a little bit, but what really matters is what the fund value is at June 30, 2020, because that's what we're going to base our next valuation on, and that's what the unfunded liability is going to be based on, and that's what's going to work into the contribution rates following year, 2021-22. the investment loss will be amortized over 20 years, but we have a 5-year ramp at the beginning, which means in that first year, which would be 2021 starting, the increase due to the investment loss is very small, but there's another increase the following year, another increase the following year, another increase the following year. So the full impact of a large investment loss like this is pretty significant 5 years down the road. And then that payment, then you're stuck with for 16 years, the rest of the 20-year period. Next slide. This is what it looks like just graphically what we're doing. So, you know, we know the return sometime in July 2020, we'll know what the return is. We'll do a valuation in early 2021 and actually calculate the investment loss. And then in 2021-22, employers make their first payment towards it, but it's that first step in the ramp that ramps up for 5 years, and then there's 16 years of full payments. Next slide. And this just shows you what that impact could be on the funded ratio. It was, had we earned the assumed rate of return, it would have started to go up a little bit because contributions have increased enough to where we're covering the interest. But it's probably going to be well below 7, probably closer to 0. So that could be a decline of about 3% in the funded ratio. Next slide. And this just shows you the actual amortization schedule. So you're not just paying for this investment loss, you're paying for all the other things that have happened over the last 20 plus years. The dark blue line at the bottom is what we had been projecting the contribution rates to be, the employer contribution rate to be, assuming we earn the 7% in the current year, which is not very likely. We're much closer to the light blue line above it, where we earn 0%. And you can see what that does. You know, in the first year, it's only a little bit higher than the dark blue line, but 5 years down the road, it's about 3% higher than the dark blue line. This chart assumes that we begin earning 7% exactly starting June 30, 2020, which isn't what really happens, right? Every year there's a return, there's a gain or loss, and that's worked in to the amortization schedule, and you get new projections every year. And with that, that concludes my presentation. I will at this time turn it back over to Susan Forer.
Thank you, Kurt. At this time, Renee Ostrander, Jennifer Rocco, Brad Hansen, and the rest of our presentation team are available to answer your questions. Please submit your questions using the Q&A feature at the bottom middle of your screen. Bill and Stephanie, would you please start us off with the first question?
Yeah, absolutely. First question from E. Graves. Can a full-time employee spend a portion of their day working in an out-of-class capacity for which their regular pay rate is reversed out for those hours and then reported with a higher pay rate?
Could you repeat that question, please?
Yeah. Can a full-time employee spend a portion of their day working in an out-of-class capacity for which their regular pay rate is reversed out for those hours and then re-reported with the higher pay rate?
So, I mean, that's kind of a tricky one, right? So, you know, the person, it sounds like, is still working in their old capacity as well, but they're just taking on extra duties. So I wouldn't consider this to be someone that's working in an out-of-class appointment. I would just consider this to be somebody that was performing extra duties. When we're talking about out-of-class appointments or temporary upgrade pay, it should be for 100% of the duties. The person's no longer performing their old duties. They're now performing a totally different job. Like my examples that I use, you know, my boss leaves and now I'm doing her job. I'm doing 100% of her job. If someone's just working additional duties, I would not consider that to be out of class nor eligible for temporary upgrade pay.
Okay. The next question is from Jacqueline Sanders Bell. How are we to report temporary upgrade pay for PEPRA if they are not reportable?
I was just answering that question actually on the Q&A, and that's kind of the whole point of it. PEPRA members, they're not eligible for temporary upgrade pay with CalPERS. However, you can pay them temporary upgrade pay. And so this is one of those few instances where an employer could be penalized. So like my example, if someone was a PEPRA member and they were temporarily upgraded to a higher level, they got paid the temporary upgrade pay, you couldn't report it to CalPERS. And thus, if they worked in it for over 960 hours, those contributions wouldn't be with CalPERS, and that's where you could run into the penalty being assessed.
Okay. Next question is from Debbie. For retired annuitants, I think I heard that the retiree can log into their myCalPERS account and view the total number of hours worked in all the positions for a fiscal year. Will employers have the ability to view the same information for a retiree?
Hi, this is Christina. For the employers, the way that they would be able to see the hours reported would be there's a Cognos report that the employers can run that would show all the hours that have been reported for retired annuitants among all of their employers.
We have a couple more questions that were sent in prior, so I'm going to pull those up as well. If anyone has any other questions that they would like answered, please type it in. D. Clark Hackenberg, regarding out-of-class pay for PEPRA members, since districts do not report contributions for the additional pay, will they be penalized if they keep the hours 960 or under?
No, they will not. So, if the person was in a temporary upgraded position out of class appointment, and let's say they met all of the criteria, there was a recruitment going on and they were in that position, and the contributions weren't coming in. If it does not exceed 960 hours, you still report that to us, but there would be no penalty. It's only when you exceed the 960.
We've had a few questions, especially once COVID started, about additional sick leave. This question says, additional compensation for working on campus during COVID-19. We have several districts offering additional compensation for employees who are essential and who have to work on site. In most cases, this compensation is pay for employees who have to work on campus. We understand that this type of additional compensation is not creditable unless the employee is doing work above their normal job classification. Does this still hold true?
For the most part, that does hold true, but for every situation, it can be unique. If you have a specific question about any type of compensation items, especially during this COVID-19 pandemic, please either send us an email or give us a call. We have an email box. I think I've given it to you guys before, but it's MOU_review@calpers.ca.gov. A blanket answer, yeah, most cases it won't be reportable, but you never know. We would rather look at the MOU and give you a well thought out answer before we just give a blanket answer.
Okay, this is a sick leave one. We have districts that are granting additional sick leave for essential staff that have to work on campus. For school members, is this time reportable when a member retires?
I don't
think
know
this
that
question
we
is
have...
about oh, go ahead.
Yeah, Brad. So unfortunately, we don't have anyone on the call, I don't believe, from our retirement benefits area, but it is for employers at the end when employers report the amount of sick leave an individual has, it's reported through, your normal process. And there is a check and balance at the end to see if there's more sick leave than someone should receive. But we have said that all sick leave that is related to the Families First Coronavirus Response Act, that all of the sick leave that's earned through there is considered reportable. And that is also in government code that sick leave is reportable.
Are employers required to report only out-of-class assignments due to vacancy, or are they required to report all out-of-class assignments?
They are required to report all out-of-class assignments. Now, keep in mind though, if they don't meet the criteria, like if you're not recruiting for the position, then you don't need to report it. Only if they meet that definition of out-of-class. Now, if in doubt, I would report it though. This is kind of a self-reporting thing. We're taking your information and assessing the penalty, but potentially this could be something that's audited down the future, and I would hate for anybody to get caught up years after the fact and then have to pay a penalty retro. So when in doubt, report it, but if they don't meet the criteria that I discussed earlier, you do not need to report anything.
Jesse Velasquez asks, if districts are wanting to pay a daily stipend for essential workers, would that stipend be reportable? And if so, how? And what codes would be used?
It's one of those things where, we would have to work with you and look at that. Is it considered a hazard pay? Potentially it'd be reportable. Is it a uniform allowance type thing? Potentially. But again, if you ever have questions on if something's reportable or not, I'd prefer that you email our mailbox instead of just give a blanket answer without knowing all of the different details. These special comps can be kind of tricky, and if you don't have it in your MOU or labor agreement written just right, it may not be reportable. So if you have something that you're looking at, go ahead and email us at that mailbox, MOU_review@CalPERS.ca.gov.
I'm going to ask D. Clark Hackenberg to retype the question in reference to what you're referring to, but we have a question from Deepa. Can you confirm that if an employee is not taking on 100% of the upgraded position, but just receiving extra pay for some duties, it is not reportable for either Classic or PEPRA?
That is correct. So for temporary upgrade pay, to be eligible for that, a person has to be working 100% of those duties. So if I'm a full-time member and I'm working 4 hours as a manager and then 4 hours as a assistant chief, I'm not doing 100% of the duties of the assistant chief. So I'm not eligible for that. Now, an employer can compensate them however they see fit, but that would not be reportable to CalPERS for either Classic or PEPRA.
Going back to PEPRA members, we only need to report out of class for PEPRA members once each year with annual reporting. Since we're not taking contributions, we don't need to report them each month, correct?
That is correct. This is it's actually separate from your payroll reporting. This is just once a fiscal year. We need to have it reported by the end of July. We do give you a grace period of a few months. So in June, we'll send you a letter reminding you to go onto the system to report. And then in August, for everyone who hasn't reported, we'll send out a reminder to them. But it's just once a year. You don't actually report it through your monthly payroll. You just go into the system under a specific tab in myCalPERS, and you can upload your information there.
Those are the only questions that I have. Susan?
Okay, great. It looks like that's it for today. We want to thank our presentation team for passing on all their valuable information, and for you, our employers, for your questions and comments. Please stay safe and healthy and well. CalSTRS will be hosting the afternoon session of the Employer Advisory Committee meeting at 12:30. You may log on to CalSTRS website to join their meeting. Thank you again for joining us, and have a great remainder of your day. You may disconnect from the CalPERS session at this time.